Hey everyone, welcome to this Angelus Foundation's webinar. The Angelus Foundation is the philanthropic arm of Angelus Investors. It's a foundation that is based out of Chicago and is a nonprofit organization that provides socioeconomic empowerment programming. And this foundation is dedicated to providing resources to three specific groups: prospective investors, including these things like webinars, investment fundamentals, due diligence, and risk assessment, community members, and startup founders. And with that, I want to start this new series that we're doing, the Angel Investor OS. And to kick it off, we decided to create the Angel Investor BluePrint. And today's conversation is designed around new and emerging angel investors, and it's focused so that you understand how startup investing actually works, how to think about it, about risk, how to evaluate opportunities, how to build a repeatable process, and how to move from curiosity to something that's like more like a disciplined participation into these startups. Again, this is not financial advice. The goal is education, perspective, and practical frameworks. And today I have a great speakers with me. I want to thank Steve and Rafael for being here. Let me introduce Steve, our first speaker, founder and managing partner at Beyond Capital Management. Steve brings like a deep experience across venture, AI adoption, founder readiness, system strategy, and organizational design. So he will help us think about how new angels can evaluate founders with more discipline and structure. So Steve, thank you for joining us. And Rafael, our next speaker, investor, Techstars alum, and mentor, and a co-founder of Colectivo New York City, which is a successful, and he used to be a founder as well. He brings both like the investor and the founder perspective into the conversation. So founder, operator, mentor, LP, investor. So thank you for joining us, both Stephen and Rafa.
Thank you. Thank you for having us.
Thank you.
Perfect. Now, so welcome. And to start, I would like both of you to briefly share your background and how you first got involved into startups, venture, and angel investing. How was that first thing that you guys did in this industry? Yeah, let's start with Steve.
Sure. Well, thank you. It's good to be here. I back in, right at the end of the great financial crisis, I took a little detour in my career. I actually started my career in architecture and real estate development. So some of you may remember back around 2010 what the environment was like. And so this gave me an opportunity to, in a sense, reinvent myself and take that same thesis of an architect and or that same posture and mindset of an architect and actually apply it to the financial plans of my clients. And so that is where it first began. I was a licensed financial advisor at that time. And then fast forward about another decade, and I had my own business, and I was setting aside some of those proceeds to invest in startups. So I took a lot of what I would call the business, the design, the leadership acumen that I developed as an executive coach as well, and started applying all of those learnings to angel investing. So probably about 2019 is when I started doing some angel investing, and I invested in a nice little portfolio of angel investments, and which has led me to move into syndicate deals and then ultimately raising a fund right now. So that's been a bit of the trajectory, but I've always taken this cross section of venture. It's particularly today around AI adoption, as you said, founder readiness and system strategy. So that has brought me to what I am working on today. So it's been quite the journey.
Awesome. What about you, Rafa?
In my case, I got into all of this by accident, I guess. I'm originally from Mexico. I went to college there. I got a degree in computer science, and then I started working as a software engineer, probably for the first decade. Then I came to the States where I met a couple people that were into entrepreneurship. Started first startup, and so that's when I learned a lot about the whole investing thing, but from a founder perspective. Later on, that company, we couldn't make it. It folded, and then we try again, and that was when we went through Techstars. So Techstars educated me a lot about all of these fundraising and seed round, Series A, all of that. So I became very curious about that. But I stay in my wearing my founder hat until probably 2018. That around that time, we were about a little pre-pandemic. A couple of friends that went through Techstars, they were starting their second company, and they approached me and asked me if I, was interested in investing. And I knew them very well. I knew they were great founders, very talented, and I didn't do any due diligence or anything. I just was, happy to sign a check for them so they can get their company started. Which, by the way, they both have achieved so much since then, and I'm very happy that I became an investor back then. And then it became kind of like I don't want to say a drug, but it became very interesting. It became like a side business, right? I had my job, but then whenever I have some spare time, I was happy to talk to founders. At first as a mentor, I mentor for Techstars, I mentor for ERA here in New York, and then it just happened organically that many of them will invite me to participate in the round. And I was like, yeah, of course, I've been mentoring you for 6 months. I know you're a great founder. I love the product. I love the approach, and I was happy to come in. And then, long story short, I look back and I had about like 25, 30 investments in 2023. And I noticed that I have been investing in underrepresented founders without even having that as a thesis. It just, organically happened. So I turned that into my thesis, and they just kept going, right? Obviously, I became, as we're going to talk probably during this session, I became a little better at judging and reading signals, but I've been educating myself into this. I'm not perfect, but it's something that I enjoy, and I love doing it mostly because the connections, I can make with founders.
Perfect. No, thank you both. And it's very interesting that you mentioned that because for what I've, Angelus investors, we have over 700 members and investors. And when you ask them and when you talk to angel investors, like that first question, they say like, no, I had a friend or my cousin was racing. That's how I started investing in these things, right? So it's very interesting that you put that aspect and thank you for providing that answer. I want to start the panel by asking this question, and is when someone says I want to become an angel investor, what do you think they usually misunderstand at the beginning, and what's that thing that you say I thought first when I was a beginner, and that how's that changed? So let's go on with you, Steve.
Yeah, I think I think okay, say an angel investor is in the space of venture capital, and these are private companies that you believe can scale to, very large outcomes. These are, whether that's $1 billion or even let's say $500,000, $500 million, depending where you are in the world, to a billion or even 10 billion. If you believe that it has the ability to scale to those levels, that's more of what I would call venture capital. There are other types of businesses that are not necessarily venture scale, that these are really small business, and maybe they even become to middle market businesses where they have really good business models, and maybe they're very cash flow. They cash flow very well and even profitable, but they don't necessarily have the scale that a venture capital company. So I think if you invest in those, that's kind of, I mean, the scale of that can get to the point of private equity where you're buying into companies because you believe that they're undervalued and you want to, buy them and then sell them or at least invest in them. So I think that's one thing, is just understanding the difference between angel investing or venture capital and say private equity. The other thing is I didn't realize that you can actually invest in companies with small checks. My thought impression was that $100,000 or even $1 million that you needed in order to invest. And I think that there are ways that you can invest much less money, in companies, whether it's through direct, investing directly with the company or going through a special purpose vehicle, through a syndicate deal, or even investing in funds, which is kind of that's not so much angel investing, but there are many different ways where you can actually, with a four-figure check, you can invest in a company. So those are just two things that jump to top of mind now about what the difference is between venture capital and private equity, and then what's the size of checks that you could potentially invest in to get into the system.
Yeah, on that topic, I think there are probably a couple of misconceptions about people that normally, when they're starting with angel investment, they have. I think the first one is that it's a money thing, right? I'm investing
Yeah.
money, and I sign some checks, and probably I'll get one of these companies to go and get an exit, or have a good successful event. However, I think that people don't understand that it's not just the money, it's the time and the effort and the energy,
Mhm.
because angel investment is not something that you just come in and give the check, and then you are out. You actually are there for at least a good chunk of the first couple years, and you become more than just an investor. These companies are looking for angel investors, not only for the check. Many of them are looking for what they call smart money. They want you to, help them make connections, give them good advice, and that's time, right? That's the real investment that you're making. The time to sit down with these founders, to guide them, to listen to their challenges, and I think that's the first thing that someone that wants to get into angel investment, they need to understand that besides the money and whatever they are willing to invest, there's the part where they are going to have to put some time into this, right? And the second misconception, I think, for people that have never been in venture, and angel investment is kind of their doorway to this world, is how long it takes to
Mhm.
actually see some of these, to see some returns, right? And it could be, as you know, 8 years, 10 years, 12 years before you actually get, like an exit. And it might be a 2x, right? You might get, or
Mhm.
3x. So I think the expectation should be that you are doing this mostly because you are going to enjoy it, like I said, connecting with founders, solving problems, learning a lot, right? Because the thing is that you learn about these new industries that you probably you knew, but you never got involved, and now you're learning about that. You're learning about new technology. So I think it goes both ways, right? You give a check on your time, but then you are compensated by a learning experience and by great relationships that you're going to build. But yeah, it takes a long time, and also it's a bet. At the end of the day, you
Yeah.
can have 20 companies in your portfolio, and maybe one makes it, right? And that's
Mhm.
something that people need, that are getting into this, need to understand. There's a saying that an angel investor should only put in companies where they're willing to lose, and that's
Mhm.
true, right? Because if you are thinking about like putting some of your your actual money or patrimony into this, then you're risking too much, right? And I think that's the mindset. The correct mindset is to come and think that this is money that you're willing to wait for it to make more money or to give you some returns.
Rafa, if I could add to that, Joshua, I think that's really important for people to understand that historically angel investments, if depending on when you invest, what stage company you invest. If you're investing in early stage, which is what we would call pre-seed or seed stage, historically it's been that your money is going to be tied up, that you won't be able to necessarily liquidate those funds for 7 to 10 years. Now with some of the startups that are happening with AI, that liquidation event might happen sooner. But you have to be prepared to have the money in there between 7 to 10 years, and not have any control on how you're able to, whether there's a liquidation event, whether the founders sell the company or it goes public. The only option you may have is that you may be able to, sell your share or your position on the secondary market, which is actually a viable option. but you need to have a decent amount of holding for that to happen. The other part, as you said, Rafa, is to use your example, if you did have a portfolio of 20 companies and only one made it, it's actually, very statistically proven to say that, two or three out of 10 might hit, and you might have three or four, if not five, that might just fail, and then another two or three that might, maybe come up to about even. The hope is that the average of all of those investments will give you two or three X what you initially invested. But it takes time for you to understand, like even your investing, like, many people will say, even if whether you're an angel investor or even a fund manager, you need 6 or 7 years before you know whether your picks are any good. And so it takes a long time. Like for those people that want to see a return in 3 to 5 years, then you're probably going to want to get into private equity, because you have maybe less returns, but you have less risk as well. So again, this is like a judgment of what are the type of rewards you're looking for, which also means that the time frame that you're going to be invested into these companies as well.
Yeah.
And that's very interesting. And I want to do a follow up here now that you guys are mentioning this, and it's to you, Steve, and it's regarding what mindset shift needs to happen
Yeah,
before someone start writing checks, because you've just mentioned it's a high risk, high rewards, right, industry and investment and asset class,
yeah.
and it's a low liquidity event that will happen for the next 7, 10 years until you see the money. So what's that shift that needs to happen in
Yeah.
someone's mind before starting?
Yeah, I love this question because I think for me, the biggest mindset shift is that angel investing is not just an investing activity. It's absolutely a learning activity, especially at the beginning. I think you have to be ready, as Rafa said, you have to be ready and okay with losing the money. This is not like a flippant thing. Yeah, I'm just going to lose money or be irresponsible. But honestly, say, hey, if I understand that the check may not come back to me, and if you're not comfortable with that, you probably should not write the check. But I think the part that really matters is even if the capital does not return back to you, the learning should come back to you. In fact, that was a really big part of the reason why I wanted to start investing, because I wanted to learn how startups evolve. I wanted to see how leaders were going to, many founders were going to respond to the challenges. I wanted to understand how do they communicate with investors. I wanted to observe what happens across the different sectors, the different types of founders, the different stages of the companies. What I wanted to do was I wanted to begin to see patterns. And I couldn't do that unless I was doing that across a certain amount of you need to have some critical mass, in statistics that tell you need to have a certain amount of data points in order for you to see real patterns. Because before you have a thesis, you really need to have some pattern recognition. And before you have that pattern recognition, you need to have that exposure that I'm saying, 10, 20. Most people will say that you probably need to have 20 positions to have a well-rounded portfolio. So I would tell a new angel, be willing to lose the money, but do not waste the learning. If you're going to write checks, write them with intention. Track what did you believe at the time that you wrote the check? What did the founders say would happen next? What actually happened next? Track how did the company communicate? What surprised you? Even track where maybe some of your assumptions were wrong. Over time, what's going to happen is that all of these observations begin to form a point of view. You start to see the difference between confidence and clarity, difference between activity and progress. And you start to also see the difference between a really great storyteller and a disciplined operator. Because a lot of founders are really great storytellers, but not all of them run their companies well. You also start to see the difference between a really compelling product and what it looks like to be a venture scale company. So that's how the conviction begins to develop. And then once you have the conviction, that goes into, Rafa, you said 20, investments before you saw the patterns, and that became your thesis. And so I think the mindset is, don't start by pretending that you have already a fully formed investment thesis. Start with humility, start with small checks, start with being curious, start with, okay, what are the things that I want to learn? I think that angel investing, if you do this carefully, can become a really powerful education in company building. And that's what I came away with. Like, I was willing to say, I'm willing to lose all of this in order to learn. So in a sense, I paid for an MBA or whatever type of degree in angel investing. And that's what you're doing. And if you're satisfied with that learning as an outcome for your first 10 or 20, I think that's probably a good sign. And I think that probably puts you in the right headspace to actually do much better than that.
Yeah, and,
Yeah.
and that actually puts you in the position in which you have to learn about new industries, right? Because at the end, the
Yeah.
startups are the real innovators and real-time innovators, right, into what's ahead in the future. And
Yeah.
maybe you're not investing in something that you truly 100% know about, and industries you don't know about yet, but you get to know them. And Rafa,
Yeah.
I don't know, what were your thoughts in there? I also want to get your founder perspective there.
Well, and just I mean, Steve is completely 100% correct about this becoming more like a learning experience that you are paying for, right? Like it's your MBA but the only thing that I would add to that is, like you mentioned, you are probably investing in something that can define your own career, right? Because many angel investors end up just like Steve, raising a fund, right? And now you're a fund manager, and you're now a VC, right? And so
Mm-hmm.
I think it's worth it if that's the path that you want to follow as an
Mm-hmm.
investor, to invest. I mean, it's redundant, right? But invest that money in learning to identify
Mm-hmm.
successful companies, make mistakes.
Mm-hmm.
Learn the red flags, all of that. So yeah, and
Mm-hmm.
and then to just to complement what you mentioned, Joshua, for me, I have an 80-20 rule. 80% of the startups I invest are industries that I know well. So, I know well fintech and healthcare. So 80% of my portfolio is very repetitive. You'll see it very SaaS, B2B, fintech, healthcare, AI, data. And then I leave at 20% for me to learn, right? And that's how I go to do some GCPs. I can do some stable coin crypto thing that I've never done before. I can do entertainment, music, stuff that I've never done, just to learn about it, right? But it's only the 20%, so I can, I manage that risk. As a founder, I can tell you that the way I see it, I mean, the number one thing that I learned as a founder that I apply as an investor is empathy, right? I was on the other side of the table many times, when I started the companies, and even right now with Colectivo, right, where you are starting to, you're always trying to start something with a partner or a sponsor, and that relationship always needs some trust to be formed, right? When I'm doing angel investment with a founder, that's what I am trying to look for, right? I try to be very empathic about their situation, and I can see if that trust is going to form or not, right? Because I understand a little bit the challenges that are going through. I want to show that it's not just me judging the company or how good you're doing, but also understanding the challenges, and understanding that it's not easy, right? Even from if I'm not involved in that industry, I am going to assume that what they're doing is very hard, and that's the reason why they're doing it. And I know that also nothing is perfect inside the company. So as a founder, also when I meet another founder, and they pitch me, and everything is going just perfect, right? That's a huge red flag. I'm like, I was a founder and everything was on fire 24/7, right? At least for the first 5 6 years, it was just chaos. Obviously, you project, security and confidence, but you can never come and say, oh, we don't have any problems, everything is going as planned, and the role of the angel investor is actually that, right? To identify, hey, where are you struggling? Maybe I can help here. Maybe I can introduce you to someone that is connected to this investor or to this customer you're looking for, right? And I think that's the value that's as a founder, that's what I bring to the table as an investor, is that I understand a lot of that psychology behind, like the masks that the founders have to put sometimes to talk to customers, to investors, to anyone, right? And looking through that, I think that gives me a little edge, right? Because you can tell sometimes when things are not being as transparent as they need to be.
Perfect. And that it's a great closure for this first section into what does it take, what an angel investing really means and really is about. And now I wanna start talking about something interesting, which is risks, return, and expectations. Because for angels, risks huge, returns potential, expectations a lot, right? And and I want to ask you both this first question, and is how should new angels think about risk and returns in the startup investing? What do you guys think on that topic? Because we've mentioned it, high risk, high rewards, but what's something that a new angel should take into consideration? Steve, let's start with you.
Yeah, I mean, one of the things to think about in terms of returns is, if you were to look, I don't know what the exact numbers are, but if you were to look at of all the statistics on how the top angel investors are returning, in their funds, or in their investment. That there's something that's called the top decile, which is literally the top 10% of all angel investors. And then you get the top quartile, which is the top 25%. And then if you look at the top 50%, and then so on and so forth, you start to see that the number is fairly high at the top, but then it starts to go down pretty dramatically as you go down from quartile to quartile. And so, like, I would say, just set your expectations, accordingly, until you have some track record of that, you're seeing the patterns and you're knowing that because it's not even just whether you can choose the patterns, it's whether you can actually have access as well to some of these companies. And so part of your choices are having deal flow, having enough companies come to you. Some people will say we see 100 companies and we'll invest in 1% of them. And that's what leads to conviction, that leads to the disciplined approach to investing and high returns. So that's a lot of companies, and that's one thing that probably most angel investors may not consider as well, is how many deals might you need to see in order to increase your conviction to lead to a higher probability. But, like, say for instance, my goal over a 10-year investment is to return 3% of my portfolio. Or rather, sorry, 3x of my portfolio, 3 times my portfolio. And that's actually would put me pretty well, as an investor. And if you're looking at, well, nothing less than 10 times or 100 times is like, okay, like, I think you need to temper a bit of what you believe is possible. Now, is that possible? Are you actually such a really good investor that you can achieve those? I hope you are. In fact, tell me what you're investing in if that's the case. But the risk is that you understand that not only do you have to see a lot of deals to identify the right companies to invest in, but on a portfolio basis, there's the power law as a concept. The power law says that again, going back to the 10 investment portfolio, you probably might get one, maybe two that will return, your whole portfolio in terms of, like, just to 1x, let alone 3x. And so, again, it's just a matter of having your money in there for a long time and being able to get a lot of shots on goal, to learn those patterns. And it's a hard thing because, they're not, and then there's the environment of also understanding that what is the liquidation environment like. For the last several years, the liquidation environment, like IPOs or even mergers and acquisitions or secondaries, Secondaries has probably been the choice for people to see some liquidation, but there aren't a lot of exits. And we're seeing some of the bigger ones, this year, and hopefully that'll put money back into the system so that more investments can happen. But yeah, it's a high risk, high return potential. And I remember somebody that said that venture capital is a way that you could get very rich very slow. In terms of if you're going to make a lot of money, it's going to take a long time because it's going to take time for those companies to develop and then return your money as well. So I don't know. I was a bit rambling there, but Rafa, I'd love to hear your thoughts on this.
No, no, I agree on there's definitely risk that has to be accounted for. I would say that if an investment is not risky enough, you're already too late, right? I've been invited to participate in a Series F of OpenAI. It's like, well, what I'm gonna do now? I mean, there's no much risk, but there's no much to gain, really, right? So I think that identifying those companies very early, of course, is risky, right? But I think that's the right time to come in as an angel. Maybe if you're a VC later, right, Series A, or something more stable, because you can bring bigger checks into that, and then what your returns are gonna be proportional to that. But as an angel, you want to be there. You want to be in the risky territory, right? You want to be in the where it's gonna be 0 or 1, pretty much, right? Now, like Steve mentioned, it's not gonna be 0 or 1. Some of them are gonna just keep growing and just growing and growing, and there's no liquidity event, but they're doing great, right? And there's founders are performing, and but investors are starting to wait. When is this going to happen, right? Like it's been, I don't know, 10 years, 12 years. So that's a risk. That's the number one risk that you will have probably, which is investing in a company that would probably take too long. And then, it's uncertain. It's probably better when, you invest in a company and many of them, they don't pass the first year when it's very
Right.
early. So you know what happened, right? And you're like, okay, I'll take the learnings from that. And then there's the third scenario, which is you get an exit, which is what Steve was mentioning, which is the rare one. But we read about all these angel investors that came very early with all these famous companies, right? But we don't hear about all the hundreds of thousands of stories of investors that put money in other companies and they didn't see anything in return. And I think we have to be very realistic when you come as an investor. Your mindset and in terms of risk is that this is the riskiest thing that you can do besides going to Las Vegas probably and putting some money in there. Now, the only difference is that this is not just luck, it's a muscle that you're training later, right? And you're going to be training your judgment. You're going to try to drive it with as much data as you can, but still, life is life. And one thing can, the pandemic, for example, threw off a bunch of good projections with thousands of companies. So you don't have any control really, right? Pretending that you have all the data points and you have a formula. I know there's Sequoia and all these VC firms that been very successful, but there's no formula really. I think there's just a combination of good judgment, luck, timing, and that's risky. Like aligning those things, it's always a risk, but it's part of it's part of the thrill, it's part of the excitement.
If I could add to that, part of this conversation, I think also, as you said, Rafa, for angel investors generally are looking to invest um, at times that are the earliest in the life cycle of the company, which also means, to your point, that it's the riskiest. And so there's got pre-seed stage, you got seed stage, and then you have Series A all the way to potentially Series G before you go public. If you do, the you could, whether you call it the survival rate or the graduation rate from each of those stages onto the next, historically you're going to see companies that don't make it to the next stage. And so if you don't want the risk, you could potentially if you want to lessen the risk, I should say, if you want to lessen the risk, you invest in later stage companies. But those are harder to get into, like say for instance, Anthropic or SpaceX before the IPO. You only a very few people have access to be able to invest in those. Those are more sure bets because they're so mature in their growth stage. but having access to those and your minimum investment is going to be pretty high. So, but if you really want, angel investors generally are going to invest in the early stages. Again, higher reward, but also higher risk.
Yeah, and and there, it's highly risky, but there's also different things that you can do so that you reduce, at least on your thesis and personal thesis, the risk, right? And
Right,
it's
absolutely.
and this is getting me into, okay, what is that 30-minute deal screen that an angel investor should do, right? What are the due diligence that you gotta do, right? You gotta take a look at the founder, the market, the problem urgency, traction, right? So I want to start talking right now about that, and I want to ask both, and started with Rafa. When you first look at a startup opportunity, what are the first things you try to understand, and before getting into detail, like, hey, cap table, all these things, what are those first things that you gotta understand as an angel investor?
Yeah, I think the first thing that I always try to separate is the product from the problem. Because sometimes there are founders that found a good technology, and I always call it the hammer looking for nails, right? Just see where we can get, like some traction, what nails we can hit. And I think the real, for me, the real deal is when the problem is something that could be solved in many different ways, and the founder just find one of the best ones that makes sense from a go-to-market perspective, from a scalability perspective. It just makes sense, right? So separating that immediately, they're not selling me a product or a technology. It's actually they're solving a problem, right? And how they solve it, that's part of the conversation. And number two, for me, also, I think for me, a deal breaker is to talk to founders that they never had anything to do with the industry or the problem they're trying to solve. That they're coming like, that we're doing a year ago something completely different. They don't have any industry connections. They didn't feel they were not the ones that felt the because sometimes you don't have to be in the industry, but you felt the pain, right? And then you understand, like, okay, there's a business here because there's a gap, and I can bridge that gap. But for me, it's a deal breaker when there's nothing that tells me that founder is focusing on that because there's some background or experience or something that drove him natively to that, right? It just seems more artificial, like, oh, I bump into this problem, and I think I know how to solve it. I think there's, as an angel investor, that you go through so many deals, and you start doing some pattern recognition also. So immediately you recognize when the founder has a great product, is trying to they are trying to solve a great problem, but the space is crowded. It's like you've been pitched this idea 20 times in the last 3 months. And then you still have a chance, right? Because now you can do your own comparison table and say, okay, I think this one, I love the problem, I love the product, and I have talked to 20 companies trying to solve it. This is the one that I think hits all the marks, right? Or at least for me, it's the one that I try to rank them a little bit. And it happens, the more you're an angel investor, the more repetition you see. That's true. It's very rare at this point that someone comes and pitch me something that I'm like, oh wow, that's the first time I hear about that, right? And so that's good because you always have a point of comparison. And then sometimes you are pitched something that you already invested in and fail. And so the best thing you can do at that point is to try to understand if the fail was because the timing, right? The first time probably, the market was not ready for it, or it was probably the founder strategy, and try to understand that someone trying it again actually might be successful. You cannot just scratch it out and say, oh no, I'm not going to invest in that anymore. I actually done it where a company that I have a portfolio failed, and then I invested in a very similar company later, and they actually did pretty well. So that's another thing that I would say, having that pattern recognition in terms of like the market and all that. But the most important thing for me will always be the founder. I think as an angel investor, you're betting on the team every time. I can tell you that 85% of my companies pivot, at some point. Some of them were micro pivots, some of them pivot completely. But just betting on the right team, right, on great founders, I think that's a guarantee. It's halfway, that gets you halfway there to a successful investment. And if not, you still have great relationship with someone that even if they fail this time, the next time they start something, they're great, right? And you're probably going to invest again.
What about you, Steve?
Yeah, for me, I agree with everything that Rafa said, especially the part about you're really investing in the founder or the founding team, especially at early stage, because more than likely they're going to pivot. So you want to be able to look at whether you believe that the founders are going to make the right decisions when they're under pressure, because they will be under pressure. In fact, with what I do is I've developed an assessment called the Leadership Capital Index, where we have all of the founders that we talk to take this 105 question assessment, and it maps them across 35 different founder traits that we believe exemplify founders that will how they respond and behave under pressure. And so we look at that as a way that we look at founders, because it is really about the founders. But I want to go maybe a little bit upstream in the process, even before a deal comes to the table. And I want to hopefully keep it simple for folks, because it doesn't have to be overly complex and with their investment system, but it just needs to be repeatable. And the idea is the goal is to make every decision that doesn't have any emotion, excitement, urgency, or fear of missing out. I remember when I was a licensed financial advisor, there was this story of, that they examined the brain waves of several different types of people, and two that they found were exactly the same was one, a person who just got a major windfall, like say they won the lottery or an inheritance. What was their brainwaves like? And a person that was high on cocaine. They said that their brainwaves, their ability to make decisions were the same. So we got to take out the emotion. And so, like, I think the first thing is start with a learning thesis, even more than an investment thesis. Start with the learning thesis, like what kind of companies do I want to understand better? What sectors am I curious about? And all kinds of questions about what is it that I'm trying to learn as an angel investor. I think another thing is to define your check size, is be disciplined with your check size. Don't say, hey, I'm going to invest 2,000 or 20,000 here and then 100,000. I think have a range of what your check sizes are going to be, how many you want to write, because you may say, I have a certain amount of money. I'm going to make, initially you think that you're going to invest in 20 companies, and then you see companies that make your eyes go wide, and you invest all in the first quarter when you had planned to do over 2 years. That's probably a sign that you're a little eager. So kind of have a strategy of your check size ahead of time. And I think also the third thing is like use a simple evaluation framework. To but Rafa, your point, I kind of look at the market, I look at the founder, I look at the system that they're building in the product. I look at whether this is venture scale. So those are some questions that I think of. And then when a deal does come through and you do want to invest in it, write a short decision memo. Like, what do I believe? What evidence supports that belief? What could go wrong? And there's a lot of things that can be part of that. And then even tracking the founder communication, because what you're doing is you're building a learning log of all the things that you've seen, and part of that is going to develop what is right and what is wrong. We've said that probably over and over again in this, but I think even before you evaluate one deal, do a little bit of homework and prepping ahead of time, because that will help you be more disciplined. And I do believe that investing does require strategies and discipline. You can't be opportunistic, but I would say, like Rafa in his example, 20% of his portfolio is maybe opportunistic, of things that he's willing to invest in something new. And I think that's a great approach.
Great. And that takes us into now how do I participate without overextending, right? And I want us to finish this webinar with this question, and is what is the responsible way for someone to start and to begin participating in angel investing? Rafa, you already mentioned you were an alum. in Techstars, you're a startup, and that get you into that world for the startup. Steve, you already have something regarding venture capital and all that stuff, but something very different. You guys' perspectives to the usual angels. So I would like to get that sense. What is a responsible way for someone to begin? Is it what would you do if you were to begin from zero right now as an angel investor?
Go ahead, Rafa.
I think that well, nowadays there are way more organizations, webinars like these, right? Like more information out there, videos that explain angel investment. When I started, I honestly I went by mentors, right? People that were doing this, and I would come and ask questions. I think that the number one step is find a mentor, find or make friends with people that have been doing angel investment for a while, because they might be able to guide you, right? I wouldn't start this by myself and see how it goes. I will always have like a couple people that I can trust, right? And I can bring in some deals. The second thing that I will suggest that I started doing very late was to have kind of my advisors. Normally, we're humans, we're biased, we love the pitch, and then it just became like, wow, this is amazing, and the founder is 3 times founder. Look at this. It's always great to hear the opinion of a second opinion, right? Of someone you trust, or someone that has been doing this also for a while. So you can ask one of your mentors, or some industry experts that are part of your network. Hey, can you talk to this founder? Can you look, or can you take a look at this pitch? And that has helped me a lot. That's a thing that I started doing late, and it actually, you can tell that things changed completely the way I was investing before. I had my own advisory board, and after, right? I think the more robust deals that I had was after I started implementing second opinions. I started talking to people that were more industry savvy than I was in many cases. And I think that's the second thing I would do. And the third one I would say for me, and this is kind of a plug-in, right, in terms of Colectivo, is join communities, right? Communities where you are in constant communication and having conversations about investment, founders, startups, and all of that. And I think that helps a lot to ease into the whole world without having you to, having the experience of investing on the first thing you see, right? So if you've been around, we always have a saying as an investor is there's always a next deal, right? There's always the next deal. So if you miss one, it doesn't matter. There's going to be a new deal coming your way. That's an important thing that you need to consider also, in terms of like, don't get FOMO about everything. And that way, if you're a part of a community where you're seeing a lot of deals coming through, you'll become you'll become used to that experience of being exposed to a lot of opportunities without necessarily having to jump in all of them, right? Because your resources are limited. And the last part that I would say, my last recommendation is, there's a blog by a guy called Yossi. I forgot his last name, but he's an investor, and he proposed this idea of investing in lines, not in points. And when you talk with a founder for the first time, you're just seeing a snapshot of where the founder and the company are at that point in time. Never go and sign a check on the first meeting, right? Always try to make that point a line in a timeline where you can reconnect in like 3 weeks, a month, 2 months, and see actual progress. Everything that they told you that they were going to do, they did do it when you finally talk to them the next 3 months later. So you start seeing, like Steve mentioned this, right? Like having some, more than the talk, it's more about the walk, right? And having this like actual evidence that things are in constant motion, that deals are being won, that their customers are adopting the platform or the product, that are striking new partnerships, that they're raising more money. All of these things are things that you have to look through the lens of a timeline. So for me, it's never, make up your mind with one conversation. Try to make it always like a 3-point, 4-point conversation that draws a line in time. And yeah, those are probably 4 of the, of the suggestions I have for new angels.
How about you,
Yeah,
Steve?
I would definitely double click on all of those, especially the communities, because a lot of times they, if there is, say, for instance, there was one community where they would invest together. Like certain deals would come through to the community, and they would have an opportunity to have a call with the founder, and then people could decide if they wanted to have the community invest in that founder, and then the individual investors would decide how much they individually wanted to invest into it. And so that's a way for people to bounce ideas, bounce questions, and like, why is this interesting to you, and hear the conversations back and forth. But I think maybe going back a little bit again, just like, say, for instance, maybe having a little bit of a sit down with yourself and say, how much money do I think I want to invest over the next, whatever amount of time, like, say, over the next year or the next 2 years, how much do I want to invest? Say it's $50,000. It doesn't mean that you have to have the $50,000 today. It means that you can, accumulate that, and as you accumulate it, you can deploy it. That's one way to do it. If you do have it all, then you can deploy it at those as those opportunities come up. But for that amount, also determine, okay, how many do I want to invest in? So that might mean that you will invest 5, 10, $20,000 in each company that you deal with. So I think it's about understanding. I mean, you can invest in very different ways with very different size checks. Like, you can invest as little as $1,000 in some of the crowdfunding platforms. Honestly, that's how I started, was through some of my deals were through crowdfunding platforms. Now, will those uh, achieve venture scale? I mean, that's another question. Like, one of them may be close to that. Um, but it's about being able to, but you could also, so you can invest directly in a company. You can invest with a group of people, like as a syndicate. So you're investing as a group, or you can invest in the fund, where, some people might say, I don't know how to evaluate or underwrite deals. Well, what you're doing with a fund is you're underwriting the manager. You're basically choosing a manager because you believe that they are the ones that are going to make the good decisions. So there's a lot of things to consider, but make it simple. Uh, get the communities, the mentors, the advisors, determine what is your system for how you're going to invest, and then just go for it. You have to be in the game. The only way to learn is to invest. There's no way for you to learn by just reading a book. You have to invest.
Yeah, and I would say that avoid the analysis paralysis too, right? Which is sometimes something that stops people from investing, but because they get into that rabbit hole, right? And of the why not instead of the why yes. But yeah, like Steve mentioned, yeah, just do it, right? At some point, you'll have to sign that first check.
Yeah.
Perfect. No, I want to thank you both, Steve, Rafa. We're on time, and for all the valuable insights that you guys are giving us. So thank you for joining us today. We really appreciate your insights, and for everyone that is attending, I just want to give like a quick next step, and it's very simple. Keep learning. First, learning from today. Keep showing up. Show up to due diligence calls, to web, to this type of thing, which you will learn, to pitches, ask better questions, learn, get your thesis together, your the amount of risk that you're you can go as high as what Rafa was saying. 20% is bets in different industries. 80% is what I am have knowledge in, and use communities like the one each of us is building, so that you can guys keep building and investing in the startups. And angel investing is a process with discipline that you guys gotta take. So I appreciate you, Steve, Rafa. Thank you for joining
Thank
us,
you.
and
Thank you for having
the
us.
conversation.
Thank you.
And